Welcome back to strategy class. In this video we're taking a look at projected financial statements, what they are and how you can create them to see how your firm might do in the future financially based on your recommendations. So the definition here, a technique that enables a firm to forecast expected financial results based on various strategies. So these various strategies will be come up by your group, right? Whatever you decide the firm should be implementing. So once you know that and you know the costs associated with doing that, you can then develop income statements and balance sheets for future periods of time. And as you might expect, that means that we first have to go into a Google Finance or Yahoo Finance and pull up existing financial statements. So you'll need to find at least 1 year of past data. It might be better to have 2 years of past data of both an income statement and a balance sheet. And then we'll project out into the future. I like to project 3 years based on whatever strategies you're recommending and how long you think those strategies may take to be noticed financially by the firm. You may want to include a bit more or a bit less than 3 years depending on how long you think it'll take your strategies to take effect. So how do we actually make these? First, you always want to start with the income statement. So we'll finish the entire forecasted income statement before we move on to the balance sheet. And within that income statement, we're going to first forecast sales as accurately as we can. Right? How much sales do we think that the firm will have next year based on our implemented recommendations? Right? So we'll usually start by looking at what were sales in the prior year, right? What's the existing data we already have? So then we can use what's called the percentage of sales method to project cost of goods sold. Right? Again, we look at data from the prior year, and if cost of goods sold in the prior year was 75% of sales, we're just going to take that same 75% and apply it to the sales that we forecasted here in step 1. We can then calculate the projected net income and spend some time here on number 4. You may need to subtract out dividends. And I say you may need to do that because obviously not all firms do give out dividends. If you look up a firm, if it's the firm you're working on for your project and determine that they don't give out dividends, you should ask yourself, is that a good idea moving forward, or should we actually start to pay out some type of dividend? So if you decide you want to pay out a dividend, or your firm is already paying out dividends and you're going to continue doing that, those need to be subtracted out from net income, which gives you your retained earnings. This is a very important line item because retained earnings is going to be our link between the income statement and the balance sheet. I'll show you that in just a minute. Once you have your retained earnings, then you can move on to the balance sheet, and whereas we finish the income statement with retained earnings, we're going to start there on the balance sheet. And then we'll go through all the line items on the balance sheet and make our forecasts based on both last year's data and our recommendations. And then the last thing we're going to do is update the cash account on the balance sheet. And this number that we're going to plug into the cash account is called the plug figure. So what amount of money do we need to place into or take from the cash account on the balance sheet in order to make sure that our balance sheet actually balances, right? So hopefully you remember this from accounting class. Total assets need to equal total liabilities. And this is true on the projected years, just like it is for any existing year. And then number 6 here is just nice in terms of presentation, right? Instead of just doing some math or doing some projections, you want to show your audience or your readers, in this case, why you made the changes you did. So it's nice if you can list some comments, especially in regards to the line items that are most impacted by your strategies. So let's take a look at what kind of an abbreviated example of this might look like. So I say abbreviated because probably your income statements will have more data points than this one does. Also, you may want to project more than just 1 year into the future. But this is good for learning purposes. Let's start here with prior year. So everything in this column here, we would have looked up on, say, Yahoo Finance, right? So we go to a company, enter their name on Yahoo Finance, and it gives us this income statement with all this data. Our job is to take this data along with our recommendations and project the future year. And so if last year we had a sale of $100, which probably, this is in millions or something, perhaps based on our recommendations that we think are really great for, a variety of reasons, we think that there'll be a 50% increase in our sales based on those new recommendations. So we take our $100 from last year, increase that number by 50%, and we have our $150 projected sales for next year. And we note how we determine that in this remarks column here. For cost of goods sold, we use that percentage of sales method. So last year, our cost of goods sold was $70 based on the sales of $100. So 70% of sales went to cost of goods sold last year. So we're going to use that same 70% this year. And then we just do some subtracting. We get our gross margin. For some of these other line items, you don't always have to make a remark, but if they are important to your recommendations somehow, then you would want to make a remark over here in this column. So then it's just a bunch of math, really. You should know this from prior classes. You get your net income, and then if you pay out dividends, you need to subtract that out to get retained earnings. If you're not working with dividends, if you don't pay out any dividends, then your retained earnings just simply is your net income. So sometimes students come to me and they're like, I have no retained earnings line item on my income statement. And when that's the case, they sometimes will name it something different, but in most cases, the firm just isn't paying out dividends, and so they stop here at net incomes. But again, if the firm isn't paying out dividends, then retained earnings is the same as net income. So projected year's retained earnings in this case was 4.75. You're going to want to remember this number because when we move over to the income statement, remember we start down here at the bottom with retained earnings on the balance sheet. And you'll notice the total here for retained earnings in the projected year is 6.75. How did we get that? Well, first thing we did is we went to the prior year's retained earnings, which was 2. And then we added in that 4.75 from our income statement. So 2 plus that 4.75 from the income statement gives us our projected retained earnings for the projected year. 2 plus 4.75. So that's the link between the income statement and the balance sheet. Then we can move to the top, but we're going to skip this cash account because that's where we're going to put that plug figure once we're done with everything else. So in this case, we would move right on to accounts receivable. And same idea here as you go through the balance sheet. Just make a note on why things are changing when they pertain to your specific strategies. Right, so in this example, plant and equipment went up considerably. Why did it go up so much? Well, one of the strategies this firm put in place is they wanted to add 3 new plants. Each of them cost $10 million. So 3 times 10 is 30. 50 plus 30 equals 80. So a really nice description of why that account changed as much as it did. Then same down here, right? Long-term debt increased a bunch from 30 to 70. Why? Because the firm borrowed $30 million, right? It had some new plants to pay for. So obviously long-term debt would also go up. Also, they issued some shares, and so because of that, the additional paid-in capital went up as well. And then once we have that, the last step then would be to go in and adjust this cash account. And the way that they got this 7.75 is because since they waited to do this cash account last, these two accounts did not balance, right? Assets and total liabilities didn't balance, and the difference was 7.75. So they stuck in this 7.75 as a plug figure, and that number then made the total assets balance with total liabilities. And it's a little hard to explain when we're just looking at fixed numbers here, so I'm going to go through an example on how to do this in Excel as well. But remember, retained earnings is key here on the projected balance sheet, and the plug figure is as well. So let's turn our attention now to an example in Excel. And so here's a hypothetical example using Lowe's. This is Lowe's home improvement store. And you see we've got some instructions here. They want us to estimate the financials for next year, use the strategies below to make some estimations, and give your rationale for why you did that. So it looks like there's 4 different things we need to consider. One is the firm is going to expand into Australia, which needs 50 new lots to be purchased. We're also going to open 10 new stores in Quebec, which means we've got to incorporate some French writing on products and signs. Obviously we have to pay for that somehow, so what's the best way to pay for that? Hopefully we did an EPS EBIT analysis to figure that out. And then number 4, if the firm is profitable, we should begin to issue dividends to shareholders at 5%. So always remember, we're starting with the income statement. We'll get to the balance sheet once the income statement is completely done. So what we would have done here is gone to perhaps Yahoo Finance and pulled last year's projected income statement, last year's projected balance sheet. So this information would have all been provided there. And our job then is to come up with the projections. And we always start with net sales. And let's say that based on these strategies here, we're expecting a 5% increase in sales, probably mostly from expanding into Australia. So we'd make a remark, 5% increase, and then we take last year's net sales and add 5% to that. So multiply it by 1.05, which gives us 53,047. And then we're going to use the percentage of sales method to figure out the cost of sales for the income statement. So in other words, we need to figure out what was the cost of sales last year when we compare it to net sales. So I'll go over here and do a little math. So it was about 66%, but I can use that exact number if I multiply it by my projection of 53,047. And so that gives me the cost of sales for my projected year. And then just do some subtraction. And we have gross margin. Selling, general, and administration expenses, that probably will need to increase due to these new French products and signage. So we can put a little note in here saying 6% increase due to new signs. Put that in the wrong place. And then we would just multiply last year's by 1.06 to get that 6% increase. So that brings us to depreciation. And depreciation, in my opinion, given our strategies up above, probably not going to change that much based on our recommendations. So I don't really feel a need to add a remark here. And the way I like to do these columns is I just compare last year's value to another line item. So if depreciation last year was 1523, what percentage is that when we compare it to, say, selling general and administrative expenses? Mathematically, what that looks like would be, what's the percentage here? So depreciation, divide that into our other expenses, right, which gives us some crazy, which is actually a percentage, so 12%. And we can multiply that then by our projected year's selling. And that'll give us a pretty good guess on what depreciation might be, even though it's not directly impacted by our strategies. So multiply that by the projected selling expense. And so, of course, that's supposed to be a dollar sign. So what we have here is 1614, which is a bit of an increase in depreciation. Again, we don't really need a remark. That's a good enough guesstimate there. Interest probably will go up, right? We need to borrow some money perhaps. So let's say 5% increase in interest. So take last year's interest of 423, multiply that by 5%. And at this point we can figure out total expenses, just sum up those three line items above. So 1537 for the total expense. Pre-tax earnings, we just subtract our total expenses from our gross margin. Gives us our pre-tax earnings. And then the income tax provision, I'm just going to use the same logic I used here. So what was the ratio last year? I'm going to use that same ratio again to project the income tax provision. So this 1178 goes into 3137. Multiply that by 3156. So you see a small increase there in the income tax provision, and then we can figure out what is our net earnings. Net earnings is 1971, and if you recall number 4 here, if we're profitable, we should begin to issue dividends to shareholders at 5% of earnings. So we are profitable, right? That's a positive number. So we need 5% of net earnings to go to dividends, otherwise known as 1971 times 5% or 0.05. Subtract those out and we have our retained earnings, and then we'll be done with our projected income statement. So projected year, the first year after we implement our strategies, we're saying retained earnings is likely to be 1872. So we need this 1872, and we're going to start our projected balance sheet by adding this 1872 into the retained earnings section of our shareholders' equity here. So the first thing you want to do is make a note. Why is that changing? Because we're adding in that 1872 from our income statement. And we're adding it to last year's retained earnings, which is this 13,224. actually do it. So 13,224 plus retained earnings from the income statement. So the retained earnings on the balance sheet will be 15,096. Then we can go up to the top. Again, we're focusing only on those line items that are directly related to our strategies up here. And we're going to save this cash for very last. That will be our plug figure. So we'll come fill in this value last. Short-term investments, that might go up a little bit, I suppose, maybe 5% increase. And certainly our merchandise is going to go up, right? We have some new stores here, and so maybe we see a 3% increase due to new stores. Merchandise will go up. Last year's inventory times 1.03. Sum those up to get our current assets. And if you're doing a formula in Excel, you do want to include your plug figure, even though it's not written in yet. Right? That way your math will work out when we get to actually balancing this balance sheet. So for now, it's 89.89, but we're going to go back to our plug figure later, so that'll still be changing. Next is property, and certainly that's going to be going up, right, because we have some Australian lots. Let's say that costs us $100 million. Purchase Aussie lots. So this number then will need to go up by 100 million. $21,577. Long-term investments, that may go up a bit again. Maybe we use that same 5%. But probably we don't need to include a remark for that. And then we can come up with total assets as well. So we just sum all of these together. And again, this number is going to change when we finish this off with the cash account. So let's move on now to the liabilities and shareholders' equity. Accounts payable, that's going to rise as well. Probably not worth a remark at this point, so let's just stick with that 5% since it's easy. Employee compensation, we're going to have some new stores here, so maybe that goes up. Let's stick with our 3% increase due to new stores. 760 times 1.0. And then we can get our total current liabilities by summing those up. Long-term debt. Okay, let's say we did our EPS EBIT analysis, and we determined that yes, we're going to need to take out some more debt, maybe to pay for that 100 million to purchase those lots. So we just need to add in 100 million here. Other liabilities, perhaps that'll go up again. Let's just keep with that 5% since it's pretty simple for example's sake. And then we can figure out our total liabilities. Okay, so then we can move on to additional paid-in capital. And typically this is the line item that will change if you're paying for recommendations via stock. So just for example's sake, let's say we're going to do that, and we're going to issue 100,000 shares, and those shares are going for $100 a piece. And we're going to use that money to pay for some stores. So issue 100,000 shares at $100 to pay for those stores. And note here, all values are in millions. So essentially what this means is that if we multiply those 100,000 shares times 100, because each share is worth $100, we get $10 million here, right? All values are in millions. So we need to add 10 to this 26, right? Last year we had 26 million. We need to add 10 million to that. So $26 plus 10, these are all in millions. So really what that's saying is 26 million plus 10 million gives us this 36 million. We already have retained earnings. So now we can figure out shareholder equity. And then we can also figure out our total liabilities and stockholder equity. Okay, so we're nearly done now, but remember we still haven't filled in this plug figure. And what we need to do in order to do that is we need to balance our total assets with our total liabilities and shareholders' equity, just like you did in accounting class. And the way we'll do that for this projection is via this cash account. So right now, our two accounts are not balanced, right? And only thing we can change is this plug figure. So we need to determine how much do we need to enter in this cash account in order for our assets and our liabilities to balance. So again, we can just go over to the side and do some math. And the difference in this case is 2,569. So because we already did all the math in Excel here, as soon as I enter this number in this cash account, we should have a balanced balance sheet here. I'll do that. 2569 will be my plug figure. See this auto updated. And now we have our total assets, which balance with our total liabilities and shareholders' equity. And we are done with this projected financial example.